All right, breaking economic news for you this morning. Stubbornly high new inflation numbers out right now showing the Fed's preferred inflation gauge, the personal consumption expenditures price index, accelerated to 2.7% for the year ending in March. Here to dig deeper into this, CNN business and economy reporter Matt Egan. This is not the number that investors wanted to see, that consumers wanted to see, nor the Biden administration wanted to see, correct?
That's right, Sarah. That's definitely right. This is going to just reinforce the sense that inflation is sort of stuck. Not as bad as 2 years ago, but not good either. Let's look at these numbers. Prices up by 0.3% between February and March. That was flat. That was as expected. But the big number is 2.7%. That's the annual increase in prices. This is moving in the wrong direction, and it was hotter than expected. Let's look at the trend for this number, because this is the big one that the Fed really looks at. And you can see two things that stand out from this chart. One, we've made a lot of progress, right? This metric was above 7% 2 years ago. We're miles away from that. But the other thing that stands out is the progress has sort of stalled out. And actually, the rate of inflation is starting to tick a little bit higher. And that is concerning because, again, 2.7%. The Fed, remember, is targeting 2%. Now, even if you remove food and energy, which can be volatile, this metric was at 2.8%. Again, that's above 2%. So here's why all these numbers matter. At the end of the day, I know there's a lot of inflation metrics, and it can be confusing. We're talking about the cost of living. The higher this chart goes, the bigger the numbers are, the more expensive life is for all of us. Obviously, food, gasoline, housing are the big ones, but then there's other stuff like car insurance that's getting more expensive, baby formula, the cost to repair your car, the cost to bring your pet to the vet. All of those things have gotten more expensive. And the other reason why this is all very important is because the cost of borrowing is expensive right now. So you think about credit cards, car loans, mortgages, and the hope had been that inflation would cool off enough to allow the Fed to start lowering interest rates, which would be nice for all of us. But the fact that it hasn't yet and progress is sort of stalled out suggests that the Fed is not going to be able to lower interest rates anytime soon. And to your point, Sarah, there's big implications for the market, for the economy, and even for the election.
Definitely politically, there are implications because this is really, really stubborn, and you're seeing a tiny trend up. They were expecting, 2.6? It was 2.7.
Yeah.
Still up from last month.
Absolutely.
Matt Egan, appreciate you.
Thank you, Sarah.
Okay.